Good morning. Still morning, still Friday, January 26th, Ways and Means Committee room. And we spent quite a bit of time last week talking about the corporate income tax and worldwide combined reporting, but we didn't actually go through the legislative language. And so we're going to do that today with Kirby, who is welcome to join us in the chair when he's ready. Just want to sort of flag one piece is that the original idea for drafting for this would have actually just been a single word change in our statute. It would have just deleted the word water's edge. But because since we passed our last corporate bill, there's been a lot of work nationally to come to sort of agreement on model language. We thought it was a good opportunity to update our statute. But if folks are like, we like this idea, but this language is too complicated, I guess, there's a universe where we could just delete a word for the same impact. Does that make sense? Okay.
Yes.
Kirby, the floor is yours when you're ready for the floor.
Thank you. Kirby Keaton, Legislative Counsel. Pat and I are sharing a computer definitely not because I forgot mine. Another reason.
Like you forgot it at home all day, or you just left it in the office? Okay, because that would be quite a thing.
That would be a problem. Okay.
It was a while where Representative Sims was doing that regularly.
Oh, what was it?
You're forgetting your computer at home.
I think it was twice.
Okay, you were a big deal though. Anyway, sorry, we're on the record.
I'm always scared of forgetting my ID badge.
Okay.
But it hasn't happened yet. So we're talking about a potential committee bill, the purpose of which it mostly is to change Vermont to have mandatory worldwide combined reporting for corporate income tax. The majority of the language that we'll be walking through is actually just lifted from the Multi-State Tax Commission's model language for combined reporting using the Finnegan method, which is what Vermont already does. So most of what we're going over is going to be things that Vermont already does. The difference between this and the current law as far as substance goes is that the MTC language would usually have an option for reporting to be done through water's edge, which is only basing the reporting off of domestic corporations. But that option's been removed in this language so that it's effectively mandatory worldwide combined reporting. And before we get into the language, I'll also make the note that using the MTC language would make Vermont law consistent with other states that use the MTC language. I've done a review of our current regulations, and I believe that this MTC language does not contradict, other than the things that we're trying to contradict, such as the reporting requirements. I don't believe it inadvertently contradicts anything else in regulations, but it would be something that you would want the Department of Taxes probably to comment on to make sure that they agree with that. So the first change in the bill is on page 2. We're changing part of the definition for Vermont net income because there's certain foreign incomes that flow through from the federal return to Vermont that's currently taxed. It's being removed from Vermont net income in the bill because the combined worldwide reporting would bring that in anyway. So we don't want to double that. The next change is on page 3, line 9, where the definition for person under the corporate income tax chapter is being modified. there's a little language up there that just spells out a lot of the things that would already be considered included. But it does add for the purposes of the reporting statutes that a person would include a combined group. And that's just because the MTC language uses that, the combined group term. And we have definitions below that on lines 13 through 17, definitions for combined group and combined return. And that's just because the MTC language uses those terms, and these are MTC definitions. So getting into substance of the bill here. On page, starting at the bottom of page 3 and into page 4, we're replacing Vermont's current language around mandatory combined returns, or mandatory combined reporting rather, and we're replacing with the MTC model language. As I said before, the intent here is to keep it the same. There is more language under the MTC. There's more language here than current statute has, but it's really just fleshing out a lot of the details that's either in our regulations right now or granting clear authority for the Department of Taxes to have regulations on this. So as a bit of a background, I mean, the current state of our corporate income tax statute is that it's compared with a lot of states, it's pretty small, like light on details. This is fleshing out those details. Vermont's currently relying on our corporate income tax regulations to do a lot of the lifting as far as filling out all of the details. So one thought here is by using the MTC language, we're strengthening those regulations by putting a lot more of words in the statute, spelling out those details and granting authority to the Department of Taxes to adopt regulations on specific areas. The next change we have is the bottom of page 5, starting at line 14. This grants the Department of Taxes authority to require corporations to be added to a group if they were left off that should have been included. That's the kind of thing that would normally be handled right now in Vermont in regulation, but if the department ever had to do that, it would have the support of the statute. Those provisions. On page 6, it starts, there will be a new section in law that deals with just combined groups and about how income is determined for a combined group and how allocation and apportionment is done. This is new for our law because we don't have worldwide combined reporting right now. And to have these sections that flesh out very specifically how reporting would be done for foreign entities is important. If we did it with a lighter hand, not using MTC language, as the chair mentioned earlier, these kinds of details would be left to the Department of Taxes to figure out in regulation, but it would have to be done because companies would need to know how to report. Starting on line 7 on this page, we have a calculation of income for domestic corporations. That's essentially the same as what we're doing now under 1A there.
So up about 5 lines, the idea is that all these subsidiaries or part of the group combine their income and then they calculate the loss as opposed to each one doing it separately, calculating their net income.
Yes, they're reporting all the income together as if they were one entity. But as we get through this calculation, you'll see how there's actually a lot of language here that has each entity within the group, each member of the group, to also separate out and apportion its income. There's places where they would separate any net operating losses. The reason why that's done, there's a lot of language around that, and it seems like a lot. But my understanding is that what happens a lot of the times is that members of a group come and go, corporations are bought and sold. So the calculation does track by those entities But the point of the taxation is to the entire group, the entire group's income, the entire group's market presence, sales factor in Vermont, and figure out tax that way. But things are also separately tracked. Like I said, just in case things are bought and sold, numbers come and go from year to year. Yeah. I think that's a good synopsis of the next several pages we'll be going over here. So, so there's a calculation for domestic corporations. It's the big A there on line 7. And then starting with the big B is what I mentioned before about calculating income of foreign corporations. It starts with a profit and loss statement, and then it's adjusted for federal and Vermont law. It's like a pro forma approach, which we've seen before in Vermont. The next big change is here on page 7, around line 8 there, where the Department of Taxes is granted authority to change or clarify how income of foreign corporation will be reported. This is just a catch-all in case they sub B before it, where the general method of doing so isn't working out for some reason. And then under
Yes, when there's an approximation, is there a true up down the line at some point? There's say, may provide further other procedures. This is line 9.
Mhm.
To reasonably approximate the income for loss and apportionment. If it makes sense to tax to do it that way, it makes sense to me, but some assurance that at the end of the day, at some point, it's trued up. Does that occur?
Yeah, the way I see this provision is if the process above it that has the pro forma kind of approach,
Okay, yeah.
if it turns out for a particular corporation and some of the activity they've done, it doesn't look like the income's actually being reported accurately,
Okay,
then it gives the department the ability to look into that and to take a different approach. Does that make sense?
thank you. Yeah, it makes good sense.
I think we were on page 7, under sub 2 there. So there's a general rule that transactions between members in a group are not going to count when calculating income. That is, you have this group of members and the members have transactions between themselves. You're not going to look at the incomes and expenses, gains and losses between those transactions. But then that's the general rule. But then under that, there are some specific rules to clarify further. Starting at line 17, you have dividends that are paid from one member to another are excluded. That is, company A, company B are in the same unitary group. One paid dividends to the other. That's just money changing hands. So that's not going to be something that's included when income's reported. But if somehow company A was pulling from a fund of money to pay dividends that's not part of the group's income and pays it to B within the group, that would be counted. That's just specifically covered. Sub A, big A, and then big B at the top of page 8 handles how charitable expenses are used. It follows federal treatment. And then starting with sub B here on page 7 or line 7 rather, it's how apportionment, it starts to explain how apportionment's done for the combined groups. Starts with all of the ordinary apportionable income, and then it removes capital gain income and losses, and it removes other items of income that are non-apportionable. And then it goes through a process of dealing with those two things that were excluded, and then they get put back in. Sub D here on line 17, it uses federal law to determine capital gains and losses individually for each of the individual items of gain or loss. And then each item is apportioned or allocated individually. And then on the next page, it continues with the process of how capital gain, and gains and losses will be apportioned.
Can you give me an example of what kind of business might use this? An
Those capital-
insurance, an insurance company, who would fall into this category?
Any sale of an asset. So it could be sales of stocks or something, but it could be sales of buildings.
Okay.
And so for those types of transactions, they're looked at individually and separated out and apportioned individually. Sometimes there could be issues with sourcing where something has to be apportioned to, or rather allocated to a state, like a sale of a building in Vermont. Income from that would be allocated to Vermont.
Okay, so would Global Foundries have to do this?
Yes,
Ben and Jerry's?
yes.
Any company that has a branch or a facility?
It's any company that sells into Vermont.
So yeah, so
Global Foundries, I don't know, I don't think actually does sell into Vermont, so Global Foundries doesn't necessarily, I mean, I actually have no idea, but my assumption is that so if Global Foundries doesn't sell anything into Vermont, which they probably maybe like, I don't know. There's a universe where they don't, that's possible, very possible. Then they actually don't pay any of these corporate taxes.
thank you for that. That's true. I don't know.
So I would focus on what I think of this as corporations that are mostly headquartered well outside of Vermont, but make profits in Vermont. So your Amazons, your Walmarts.
Okay, now I got it.
Okay.
Yeah, okay.
Scott, were you going to jump in with what I just jumped in
I
with?
was just gonna, does that, include trademarks, licenses? As far as things that are, portionable? It include all that kind of stuff? The squishy stuff that they use to move money.
The little intangibles?
Yeah, exactly, big global intangibles, does that capture that?
You bet.
That definition, think so?
I believe, I am not a corporate tax whiz, but I believe that, yeah, the sale of intellectual property rights,
Yeah.
would that be
Right,
treated as capital gain? I believe so.
okay.
That sentence again, I'm sorry, the sale of,
Sale of intellectual property rights. Is something so taking a step back, I mean, what we're going through here is just figuring out how that income is determined for each item of income under this language, and then how it will be apportioned in Vermont. With
Again, this is current law.
with no significant difference in how it's currently being done.
So does everyone follow? We're basically just talking about like tightening our statute on current law. Okay.
So
Sorry to the members of the committee who were not here 2 years ago when we like really tortured our way through this decision.
Thank you.
Yes. Okay.
I wish I were here for that. That would have been a lot to learn.
I'm sure we'll
So-
find other things to go
Yeah,
through.
right.
Projects on.
Don't
Don't
worry.
Missed opportunity.
There'll be a lot of learning and torture to come. So sub 5 on the bottom of page 9 deals with how capital losses can be carried over to reduce capital gains in future years, but cannot be used to reduce income types of the current year. That is, you can't take a capital loss and put it towards ordinary income for the current year, but you can carry it forward to reduce capital gains in the future. Starting on sub 6, there's a process for assigning a capital loss carryover so to a single entity. This is what I was talking about before, where we have sections that or some subdivisions here that go into how capital loss carryovers will be done, how things will be done on a single entity basis. It's not because we're taxing on a single entity basis, but because sometimes these companies within the group are bought and sold. On page 11, we have, this doesn't make you sick. On page 11, we have more processes for assigning net capital losses. There's quite a bit of language here for that. Starting with sub E on this page on line 6, we have how to allocate to Vermont non-apportionable income other than capital gains that was already allocated. Non-apportionable income, one example, just to let you know what that means, one example from the current Vermont regulations of non-apportionable income would be let's say there's a clothing business that makes sales into Vermont, and because they make sales into Vermont, this clothing business has to file a return with Vermont. They own a building, let's say in another state, and the first 2 floors of the building are used for the clothing business. So income generated from those 2 floors of the building would be apportionable to Vermont because that's the business that's the primary business for this company. But then the rest of that building is rented out to other businesses for their use. So that's income, but it's not part of the business activity that's being done in Vermont. It's separate. So that would be non-apportionable. And so income in categories like that have to be allocated to a particular state.
Representative.
Thank you. So when you, like depreciation, all the other things that go along with that building, would that all be, how does that happen?
How is it reported for
What are
corporate
you doing
income?
that, Peter?
I mean,
Just wondering if they're gonna, if
right.
they can get away with not like, if there could be some way this is, could be worked in there. That corporations will start to rent out the first 2 floors of their building to other things.
Well, so you were asking about the accounting part of it, of depreciation.
Yes.
I'm not sure how that would come into play for income tax reporting. If the building's not being sold right now. So I might have to get back to you about some of the details about the accounting side of that. But for our purposes here, that the other floors of the building, the rental income is not going to be taxed by Vermont. It's not going to be allocated because it's in another state. Like that's the point we're getting at here. Does that make sense?
Yeah, that makes sense. I just wondered what they're gonna do with the depreciation and all those things.
Would you like me to send some additional information about how the accounting works with some of that? Okay, yeah.
Back to you, Kirby.
Okay. So sub F here is starting to finally get to determine the combined group Vermont net income or loss before we start getting into net operating losses that were carried forward. And so it combines the ordinary apportionable income that we started with. It combines the capital gains income after going through the process that we just walked through and adding the non-apportionable income that's allocated to Vermont that we had also just in the section above, the subsection above covered. So all of that's added back together at this point in the process. And then we start getting into net operating losses from prior years and how they're deducted. There's rules for net operating loss carryovers. Going on to page 12. There's rules for net operating losses from the members that are new to the group. So it'd be a member that was acquired, right? And then on to page 13, there's a process for attributing net operating loss carryover to a particular member. As we said before, that's so that the member has an NOL attached to it, so that if it's not a member in the future, that could be used for that entity. And then going down, we have big A here. And this is how a single member net operating loss is calculated, like I was just saying. And again, this is, you know, just putting into statute current processes, right? And at the top of page 14, there's more process for a single member's net operating loss. And then starting at subsection H, line 11 on page 14, it describes the process for assigning Vermont tax credits to individual members of the group. And then there's a process for determining what tax can be offset by Vermont tax credits. It starts by isolating the ordinary apportionable income of a particular member that qualifies for a credit. And then it adds that member's share of the capital gain income that was determined earlier in the law here. And then plus or minus the non-apportionable income generated by that member. And then plus or minus any adjustment to properly reflect separate entity losses. And then that's multiplied times the tax rate. And then you have the amount that a credit can be applied towards. Starting on sub I, we have apportionment for the group. And this works with the section of law that we already have about apportionment and allocation. The general rule is that a combined group apportionment will follow the current law, which is section 5833 of Title 32. And then there's some subdivisions here that specify certain circumstances. The first one is how the combined group is apportioned. The second is how a separate entity is apportioned. And then on to the next page. How to do apportionment when there's partnership income involved for one of the members. And then it sorts out what partnership income would be considered to be taxable. And then finally, we have a change. This is not part of the MTC. This is just an addition for this bill that adds a legislative intent provision to the corporate income tax chapter that says that it's the intent of the General Assembly that the interpretation of this subchapter, the subchapter being the corporate income tax part of the income tax chapter, shall follow the unitary business principles as recognized by the Supreme Court of the United States. And the unitary business principle is that unitary groups should be taxed as a single entity, which is what all of the changes over Vermont law in the recent years have amounted to, and what a lot of the MTC language here kind of works out.
Representative?
Thank you. So at the, on lines 12 and 13 of that page where we're on page 16, it says something about it's not possible to determine the member's share of apportionable income. The commissioner may provide rules for inclusion of particular partnership factors. So would those be rules as in going through LCAR rules, or would those be for?
Yeah. That's a lot of the times, you know, we say regulations usually, but it's a term of art. Rule means the same thing as a regulation.
So let's say there's a year where it can't be figured out. Commissioner says, oh, we're going to need to figure this out. What happens? Does that tax return go on hold? I mean, does the amount of taxes go on hold, or what happens while the rules are written?
I can't speak for the Department of Taxes. I can speak from my experience having worked there, just so anecdotally, not officially, of course. You would not wait for a rulemaking process if you have a return in front of you. You would make an interpretation at that time without the certainty of a regulation, and the taxpayer could potentially appeal that, and then it would go through a hearing with the commissioner and possibly the court. So the regulations, the point of them is to sometimes regulations are adopted where you have a scenario like that, where there's ambiguity. And for the future, so the department doesn't have to go like put its neck out and make an interpretation, when it's in regulations that has more force of law and it can be followed.
Then the commissioner would deal with that. The person would have, the corporation would have the right to appeal and whatever, but, and then do you think that the commissioner would say, well, I'm gonna go through rulemaking for this?
We can actually have the commissioner in to answer questions about the rulemaking process. No, nothing to apologize for. It just seems like he's a more
You're right.
appropriate person to ask that question. And I'm sure he's gonna want to come in to discuss this bill and many others before the session starts.
Right. Thank you, thank you.
Yeah, Representative Anthony.
Is there anything in here, and I ask this having not seen any, that is unique, that we're filling in some kind of blank that the Internal Revenue Service has not already dealt with? Most of what I've seen so far is incorporating, and by reference, practices for unitary groups that the IRS has already settled. And what we're doing is essentially saying, we're going to follow the IRS practice in this, and this, and forward losses and carrybacks and all that stuff. Am I got that?
Yeah, so the MTC language does use a lot of references to that.
Is there anything unique, though? I'm trying to figure out if there's something here that we had to add that the IRS has not anticipated in dealing with a
Well,
worldwide unitary reporting scheme.
yeah, so the IRS does not follow worldwide combined reporting. So Vermont would be different. I think that's so the major thing here would be different than the
But the
other.
practices of
The practice.
apportionment and that already exist for multi-state enterprises, essentially.
Yes, and using the MTC language like this is, the most standard, consistent language that's out there
Okay, that's what I was getting
in the
at.
states. Yeah.
Okay.
Okay. What's next? Do we have an effective date?
Yeah, effective date.
Is there anything before? That was the next thing, right? I'm not skipping ahead.
Nope.
Okay, great.
So as it's drafted here, it would be effective retroactive January 1, 2024, and apply to taxable years on and after January 1, 2024. That just means next year's filings. I think sometimes the retroactive thing can throw people off, but that's just used a lot for this tax stuff.
And that's definitely something to discuss. So when we did the last corporate reform bill, we taxed
same.
it like a few years out. We
Yeah.
didn't make it retroactive, and so that's definitely something we could, think about.
Trying to remember what we did for an effective date on
I
that.
think we did it like a year and a half
It was in the
out.
future for sure.
I see Pat nodding in agreement with me. You can't see Scott not, you can't see him nodding in agreement because he's sitting behind you, but yes.
Was that decision about a year out or 2 years, was that at the request of the Commissioner Folio, or was that just in deference to the wider world who have to do the filings?
I think it was to the wider world,
Okay.
Mhm.
give them a
Okay.
chance. We didn't
Yeah.
wanna get in the middle of a tax year. or
No, yeah, I
It
get
was
it.
very much about giving people a chance to adjust
Yeah.
their situation.
Understood.
About the department, actually, though we are happy to adjust things for the department sometimes. Yes.
We're pretty small. Is this going to cause some businesses not to want to do business here anymore?
I do not know, but I am sure we will hear from you. Usually, in past conversations we've had about this, it's even paying corporate taxes in Vermont is such a small part of a corporation's total tax responsibility that it wouldn't even be worth it for them to do that. It's sort of easier to pay the taxes than to lose the market. Because it is all proportional to the sale, so it's always gonna, the tax responsibility, but that's something that we can certainly work through. Any other questions about the bill? And we will hear witnesses. This is not including the commissioner and other participants who want to. Okay, thank you, Kirby. Pat, I believe you are next up with us. And Michael and Don, I really appreciate you're here. There is a universe where it's possible we will not get to you today, and I am sorry. I hope you are able to be productive in other ways at your computers inside the Zoom screen.
Totally understand. Thank you.
Okay, thank you very much.
All right, so Patrick Titterton, Joint Fiscal Office. So the last question there on the effective date, the last bill that you passed in the corporate space, you did during the 2022 session. And the effective date for that was to become effective for the tax year 23 year, which means that this year was the first year that we'll get those filings from the corporations. And I have some slides which are posted to the committee's website. The first big chunk of it is all the same slides that we looked at last time I was here. I just wanted to have the materials with me again, just in case there was anything you all wanted to cover from that discussion last week. And so we had, the two types of businesses and how the tax department treats them. We looked at, the existing tax regime that you all did during the 2022 session and what those changes were. We have the tax rates and schedules. We have a look at other states and how they treat corporate tax. We have this chart, which both Kirby and I showed you. There was a little bit of information from Tom and Jeff's forecast. And then, just a little bit more just on what portion of overall revenue we get from that into the general fund compared to our other sources. We looked at it over time. We looked at the volatility of this specific type of income source. And we also looked at what that looks like on a national scale, along with the more detail on those recent changes. So was there anything with what we covered last time I was in here on corporate that you wanted to revisit?
It was not.
Okay. You guys are all quick.
I'm not quick, but I don't even know what question to ask.
And a reminder, there is a corporate income tax 101 sort of training on our Ways and Means landing page. That's really good. Just right there for everyone's watching and reading pleasure.
And it includes stuff that went in last,
Yeah, that's what it's basically about. It's about all those changes that we made
okay.
to last biennium, 2 biennium ago.
2 biennium. No, that's fine.
Last biennium.
That's fine.
Yeah.
Anyway,
Social can help us get there.
it's like, yes, but it's like really right there.
Yeah, 21.
Pat,
Just as an added plug for that, there's 2 presentations that you'll find on your webpage. One from Abby Shepherd, which will walk you through all the technical legal stuff, which Kirby's covered a lot of for you. And then also a presentation that Emily Byrne gave for the tax workshop. So I have a sort of few background information slides on here, some pro forma, just to look at how this might affect different corporations differently. There's this bar in the middle of my screen, which I hope is not showing
I
up.
can't see it. No, I'm
It's
sorry.
blocking some of the words for me. So the question is, will corporations end up paying more under this, new structure? The short answer is yes, but that may not necessarily be true for all corporations. And a lot of that has to come down to whether the relative profitability of their domestic business is more or less profitable than their foreign business. And so just as a reminder here, the net income is what we tax, but we look at gross receipts when we're talking about apportionment. And so in Vermont, I guess partially to one of the questions I heard earlier, they're apportioning their income solely based on how much they're selling into the state, not based on any sort of physical presence like they were before. So this shouldn't have an impact on the decision whether a corporation wants to base itself here. Because that really, the amount of tax that they end up having to pay on their corporate income is really just defined based on the amount of sales that are happening in the state. But the tricky thing is here, on one hand, you're going to be increasing the net income by drawing in the foreign profits, right? Which is going to increase the size of the pie that you can count for net income and tax. But on the same, because it's, on the other hand, because it's all foreign business and sales, that's going to drive your sales factor down, right? So on one hand, your income's going up, but your apportionment factor is going to be going down. So really, the determination of whether a company is going to be paying more or less is whether the net income grows faster or slower than that apportionment factor. And so just as an example of like a instance where a foreign entity may be more profitable, if you've got a holding in a tax haven overseas somewhere and it holds all of your intellectual property like patents, copyrights, those kinds of things, companies will sometimes shift their domestic profits to that entity based on the fact that they're basically compensating it for holding that intellectual property. And that's just one instance or an example of how some firms will structure themselves to draw down their domestic net income and apportion that, or basically send that net income to a haven that is taxed at a much lower rate. Any questions on that piece?
They tax in a lower rate, that's in the Bahamas or wherever it is.
Yeah, I mean, I think.
Wherever the haven is.
Yeah, I mean, I think, Cayman Islands is sometimes thrown around as one, Bermuda, Guernsey, Ireland is one.
Thank you, sir.
So I've got three sort of pro forma examples here that I'll go through just to show you how that sort of the relative profitability flows through. And in all these examples, domestic, let's just assume Vermont is the entire United States. It's the most important part, right? So this firm, they have $10,000 worth of sales in Vermont. And they also have $10,000 worth of sales, let's say, in Canada. They're both making the same amount of profit. It's 10% of those sales represent net income or profit. So under the Water's Edge approach, we only care about what you're doing domestically. That $10,000 of sales is your only basis for your apportionment. And so you're pulling in the $1,000 worth of profits. All of those sales are domestic, so you get 100% of that in your net income calculation. And so the taxable income there is $1,000. But if you shift to Water's Edge, then you're pulling in $2,000 worth of profits, but your apportionment's going down to half. So again, sorry?
I think you just said if you shift to Water's Edge, but if you need to.
Oh, and so the Water's Edge was the first example, and then now I'm talking about worldwide.
Thank you.
So you have the $2,000 worth of net income now that you're considering, but your apportionment is half. So you still end up with the same amount of taxable income. In an instance where you're more profitable in Vermont than you are in Canada, let's say you have 15% of your sales in Vermont represent profits, but only 5% of those in Canada represent profits. So under Water's Edge, you're pulling in that $1,500 that you see up there. That is your net income that is apportioned to Vermont. You get all of it because it's all done domestically. And so that again represents the full amount of your taxable income there. But then if we're pulling in the foreign, we start with 2,000, but again, your sales factor based on the sales here, not on the profits, your sales factor is still going down by half. So you see here that by pulling in $500 more of income, but driving your sales factor down more quickly, you're actually looking at $1,000 of taxable income. And now this last example here is what we would expect to be the most likely scenario, particularly for large multinational corporations that are engaging in that sort of offshoring of profits, like the example I gave with the intellectual property. Here, 5% profitability in Vermont, 15% profitability in Canada. Under Water's Edge, you just have that $500. You get all of it, but it's just that 500. Pulling in the Canadian sales, your profits or net income is going up to that 2,000 figure again. And this is an instance where you'll see that taxable income actually grows. Because that foreign entity is, and another thing just about with the intellectual property again, one of the reasons why that'll be so much more profitable than your domestic business is that you don't really need to have a lot of overhead, right? You're just holding that intellectual property. You probably need some lawyers, accountants, all that, but it's not necessarily going to be the same level of capital intensive or any other type of business activity that you're running. So that's one reason that you would expect to see profitability in that way to be higher than your sort of domestic dealings. Okay, so those are the three sort of pro forma examples before I move on.
Just, I want to understand this from like a little bit of a practical perspective. So, worldwide reporting enables us to ensure that someone is not offshoring their profits. That I understand. In this example, though, let's pretend that the foreign profits are not a result of offshoring. They are just profits from Canada that are legitimately in that bucket. We would still achieve the same amount of taxable income. Is that accurate?
I mean, it depends on the company, right? But I mean, I think what you're talking about might look something more like what we see in this example here, where you have the same type of business, you're not offshoring, you're just conducting the same type of business in both locations. So you would expect, barring any like significant, I don't know, rent or wage or anything like that, differences between the two locations, you'd expect it to look a little bit more like this example. So you do kind of end up in a similar situation with the taxable income at the bottom line.
Thank you.
Great. So one of the most difficult factors, I know you all were asking me some questions about estimating this last time I was in here. One of the most difficult things is figuring out what our taxable base is here because, no one really officially reports this. There are some ways that estimates have been made. CBO has done estimates.
CBO?
Congressional Budget Office. They worked for our Congress, and Joyce actually worked there for many years. So they've done an estimate. There are multiple academics who have done estimates. And I've seen just in recent estimates and things that I've reviewed, there's a range that exists down from about $142 billion in foreign income that's, would be drawn in, all the way up to about $558 billion. So it's a pretty big range. And, it's something that a lot of smart people, academics are working on to try and pinpoint more accurately. But, that's not the only thing that we need to figure out here. It's the other piece of the pie is figuring out how does this affect apportionment to Vermont, which we saw matters a lot in those examples that I just ran through. There are a couple of recent examples that I've seen, one of which being, or two of which being, ITEP came up with a way of doing this, which I believe it was in 2019, and I believe their base that they were using was about 300 billion in 2019. Minnesota recently was considering this type of proposal, and they used a very similar method. What they did on apportionment was they actually went and looked at their tax return data and were able to come up with a sort of statewide average apportionment. And what that does is it just says what piece of this $300 billion or $265 billion that we're talking about can we actually say would be attributable to Minnesota. And that's what I'm doing. I'm doing something very similar to that. I am using a slightly newer figure for the base. Recently, a paper from Gabriel Zuckman came out, and he, as his sort of preferred metric that he's using, estimates it about $432 billion in foreign income that would be drawn in nationally, right? Nationally into the US under worldwide.
That's a lot.
Yeah, it is a lot. There's a lot of really big companies out there, right? And so one thing that I'm still working through, so I don't have a hard number for you now, you'll see a range on your screen, is I'm actually working with our tax department to do a similar process that what Minnesota did, which is to look at existing returns. I can't look at them myself personally because of the confidentiality, but working with Jake to get to what we could reasonably expect the apportionment to Vermont be, which is why you see sort of a big range here, that 20 to 60 million towards the bottom. I will say the 60 million, that's sort of scaling based on GDP, which is not going to be a good metric here. So the high end of the range probably is not incredibly realistic, but it's one way of scaling that I've looked at. But you know, I think what we get out of that apportionment, sort of the statewide average, will be good for us to really hone in on what we could reasonably expect for our state. It's a little tricky because the most recent implementation that's complete that we have to work with was still under the 80-20 rule. So some of it just involves some reverse engineering and querying the right or recompiling the right information. So the apportionment is a very sensitive piece of the estimate, which you can see why we have such a big range right now, but I hope to have a more concrete number for you in the very near future.
Thank you. It gives us a sense of scale, which is, I think, sort of the most important thing when thinking about something like this.
So short answer is yes, I do expect this to raise money.
Thank you, Pat. Scott.
And Patrick, have you done any thinking about, so the corporate income tax as it stands right now is, it's kind of a volatile revenue stream. Would go into more, beyond water tech approach, would it take some of that volatility out, you think, or?
That is a great question. I don't think so. But one thing that we did look at last time was those national charts showing US corporate income growth over time.
Yeah.
And it is, much more volatile than you'd see in something like personal income. But it does sort of have a much smoother, on a national scale, smoother trajectory than what we usually see here in Vermont. I think part of that is things with big bases always have smoother appearing
I guess that makes sense, yeah.
trends, but
Things with big bases.
yeah, it's the most sustainable, sort of reliable tax sources are those with large tax bases. The narrower your tax base, or like the fewer people paying, the more volatile it's always going to be, because a lot of it, especially when you get down to smaller groups of people, the one-time events really do get amplified in the results.
In the last few e-board meetings, both economists have been like very tickled with how diversified our corporate tax base has become over the last few years compared to what it used to be. And I say it that way because there are certain things where they just go like really deep and they become like very just fascinated by it, like less than it's sort of less about the impacts on the state and more about them just getting like lost in their economic dorkery. And so this was like one thing where they were just like very excited and interested in just how many more payers we have than we used to have.
Nerded out on it.
They really nerded out on it. And it's really interesting given that, like, I think when we were first doing the corporate reform, there was a lot of concern about the volatility and how there are so many more payers than there used to be now. Did you have something?
The more diverse the corporate world is that we're capturing from, the more insulated they have configured themselves to get around kinds of volatility. So the bigger the universe, the more stable it is. That's great.
In keeping with that and what Peter just said, I appreciate you using the term economic sorcery. But as you just pointed
Did
out,
I really say that?
remember from
She
Barry,
said Dorker.
the more diverse their access to information, the less sorcery it becomes, or whatever good word is there, credible versus credible anyway, but you understand. Reliable, there you go.
Yeah, and I think I said dorkery, meaning like nerdery rather than sorcery.
Okay.
But I like the idea of economic sorcery as well. Thank you, Pat, for your economics bursary. Appreciate it.
Thanks for not calling me a dork.
And, you know, I meant that with all of the love. So Don and Michael, thank you for your patience. Would love to hear your thoughts on the conversation we've had thus far, where we're going. Welcome to the committee. The floor is yours for 20 minutes.
20 minutes, terrific. Thank you, Madam Chair and Vice Chair Cantfield, Ranking Member Demrow, and members of the committee. I'm Michael Mazarov. I'm a senior fellow at the Center on Budget and Policy Priorities in DC, where I've worked on corporate tax policy for 26 years. And then I actually was the Director of Policy Research at the Multi-State Tax Commission that you've heard mentioned in connection with this bill earlier. So, Madam Chair, it would be helpful if you gave me a little guidance. I mean, the committee should have my prepared statement that I sent. So it would be helpful to have some guidance. Would you just like me to sort of hit some high points? And
if you could hit the high points of your prepared statement. To be perfectly frank, we do not always read all of the written testimony as thoroughly as we should. So
All right,
the more you
well,
can tell us verbally, the better off we all are.
I am happy to do that. Thanks.
Thank you.
That would be helpful. I guess the first point of my written testimony is to just commend the chair for and the drafting folks for deciding to base the bill on the MTC model. The MTC model was developed through a very careful, meticulous process that the MTC goes through in developing model bills. It got a lot of input from the business community, the multi-state business community. They worked very constructively with the commission on it, and it also has the great benefit that there is a lot of interest in worldwide combined reporting at this point, and Don and I are getting frequent queries from legislators in other states about doing worldwide combined reporting bills, and we are urging them to the extent possible to base bills that they're introducing on the MTC model, not only because it was very carefully thought through by experts on both the public and private side, but also because if states go forward with worldwide and they base it on the MTC model, it will enhance interstate uniformity, and by doing that, it will mitigate the compliance burdens of multinational corporations that might become subject to worldwide combined reporting. So I commend you, at least initially, for basing the bill on the MTC model, and I hope that when the business community comes in and testifies or lobbies on the bill, they will certainly, they will not be happy about worldwide combined reporting, but I hope they will say that at least if you are going to go forward with it, we do support it being based on the MTC model in the interest of its careful drafting and uniformity. So I guess that would be sort of my overarching point about the bill itself. You heard a lot from Don last week about the seriousness and the research demonstrating the problem of international profit shifting that the bill is focused on solving. It's a serious problem. He cited lots of evidence. I won't go into it again. I'll just refer you to that evidence, but it's a serious problem, and worldwide combined reporting really is the most comprehensive option for states in dealing with it. I mean, I'm not sure that I want to hammer home a point that I believe Don made last week about worldwide, but it's very important to realize that the U.S. Supreme Court has upheld the constitutionality and fundamental fairness of worldwide combined reporting, specifically on two different occasions. Back in 1983, the Supreme Court had a case, Container versus California, where it upheld the constitutionality and fairness of worldwide combined reporting as applied to U.S. parent corporations. And about 10 years later, in 1994, it upheld the constitutionality of worldwide combined reporting as applied to foreign parent multinationals in the Barclays Bank case. And so there are no potential legal challenges to a state's adoption of worldwide combined reporting. There are sort of subsidiary potential legal challenges that unhappy corporations could file based on how a particular state decided what did and didn't belong in the worldwide unitary group. But fundamentally, worldwide combined reporting is above legal challenges of policy. And that is not true of some of the other alternatives that are available to states in terms of mitigating international income shifting. Most specifically, Vermont and a number of states have conformed to the so-called GILTI, Global Intangible Low Tax Income provision that the federal government adopted back in 2017 to claw back some of the revenue lost to international profit shifting. And, the business community has written a half dozen articles explaining why conformity to GILTI, it violates the Foreign Commerce Clause of the Constitution. And so, it might very well behoove the committee to ask the Revenue Department at this point how many cases. GILTI has been around and part of Vermont law for 6 years now, and people in the business community have told me that challenges to the constitutionality of GILTI are bubbling up in state appeals processes following audits, and corporations have filed for refunds on the basis that GILTI is unconstitutional. So it might behoove the committee to get information from the Vermont Department of Taxation as to whether there are challenges to its GILTI conformity, but certainly the business community is rattling the sabers and threatening litigation on that. And again, there's no constitutional question whatsoever about the legality of worldwide combined reporting. So I think that's a very important point. The other argument, another key argument in favor of states' adoption of worldwide combined reporting is the level playing field for small businesses argument. And I think Don touched on that last week, but I just want to hit home again. Small US-only corporations without foreign subsidiaries, are often competing with multinational corporations for foreign exports. They're unlike the big guys, they're exporting directly from the United States to foreign customers. They don't have foreign distribution subsidiaries that they're selling through, but they're competing with multinationals. And under the current situation, those multinationals that do have foreign, are big enough to have foreign subsidiaries in not only, in the companies where they're actually selling their stuff, but also in foreign tax havens, can shift a lot of that international profit, pay lower effective tax rates than those smaller corporations that are exporting directly from the United States do. And because of that lower federal tax liability, they can afford to shave their prices and outcompete those domestic small businesses. And so I think revenue is a very important issue, and tax shifting and the revenue that's being lost, but an equally important issue and an equally important, if not more important, argument for worldwide combined reporting is just this basic level playing field for small businesses that are competing with multinationals.
I really appreciate you making that point, Michael, because I personally lose track of that in the context of all of this. I think about the revenue. I think about how important it is to make sure that folks aren't essentially hiding profits. But that sort of third piece about the competition is really important when we think about our Vermont businesses and even our, national American businesses. So thank you.
Right. And I have a quote in my written statement from the recently, one of the Biden administration had the great good fortune for the last several years of having probably the leading expert in the United States on international profit shifting as Deputy Assistant Treasury Secretary for tax analysis until a few months ago, Kimberly Klausing. And in my statement, my written statement, I quote testimony that she gave on this issue to the Senate Budget Committee just last week. So let me just read the quote to reemphasize the importance of this and the obviousness of it. She says there, multinational companies have ample opportunities to shift income offshore that belongs in the U.S. tax base, lowering their tax burden at home, reforming international tax rules to ensure that large dominant multinational companies pay adequate tax on their foreign income is essential for revenue, but it is also essential for creating a level competitive playing field, benefiting the many small domestic companies that compete against large multinational companies. So again, a point that the leading economic expert felt compelled to stress last week. And then finally, I just want to make a couple points about the issue of sort of the administrability of worldwide combined reporting, the ability of corporations to comply with it, the ability of the department to enforce on that basis, because there were a lot of questions that came up about this during Dawn's testimony last week. So the first point that, so I will assert that corporations can comply with worldwide combined reporting and states can enforce it. And here are some of the points that I think it's important for members of the committee to know, because again, there are questions about this came up last week. Under U.S. financial accounting rules that apply to publicly traded corporations, they already must create for their stockholders consolidated financial statements for their U.S. and foreign operations. So when it comes to reporting to their stockholders, they're already combining their foreign profit with their U.S. profit. That's what they have to tell their stockholders. Now, of course, the financial accounting rules differ from the tax accounting rules, but the issues that get raised about, oh well, all of our foreign companies' books are kept in a foreign currency, and the accounting rules are foreign. And that's a problem for worldwide combined reporting. Well, they already have to address all those issues for their financial statements. So
under U.S. law, they already have to do that.
Under the rules of the Securities and Exchange Commission, they already have to do that if they're publicly traded. So that's the first point. The second point is that even under federal tax law, they're already required to calculate their profit their domestic profit on a what's called a consolidated basis. And if you look at the bill basically says that with respect to the U.S. members of a worldwide combined reporting group, they're basically to follow the federal consolidated, the Internal Revenue Code federal consolidation rules for combining the profit of the U.S. parent and the U.S. subsidiary. So they're already doing that for federal tax purposes. They already have to. And now under this GILTI provision that I mentioned, they're essentially doing combined reporting of all their foreign subsidiaries. That's what GILTI does. For the first time, GILTI requires them to figure out a combined profit for all their foreign controlled corporations, again, and restate it to U.S. in U.S. dollars and under U.S. accounting standards and U.S. tax rules. And then the difference is that under GILTI, there's different rules as to how that, from what worldwide combined reporting requires, as to how that foreign profit of the foreign subsidiaries that they're calculating under the GILTI rules gets apportioned to the U.S. But it is really a form of sort of worldwide combined reporting, or combined reporting for their foreign entities. And so now under worldwide, essentially what we're doing is we're basically saying, take the federal consolidated profit that you've calculated for the U.S. parent and the U.S. subsidiaries and add to it the consolidated profit that you've had to calculate under GILTI. And now under worldwide, we're going to add those two things together and we're going to tax a share of it. So again, the notion that somehow this that this is beyond their capability or very different, excuse me, very different from what they're doing now is not accurate.
Thank you, Michael. We need to wrap there, so I'm gonna give you, like, if you want another, sorry, I don't want to totally cut you off, so if you, but just,
Thank you. I'll get two more
Thank you. Okay.
more points just
Thank you.
to emphasize. Alaska still to this day, as it has been doing for decades, requires worldwide combined reporting for oil companies. And there are 10 states that allow companies to elect between worldwide combined reporting and Water's Edge combined reporting. And it is reasonable to presume that a significant number of corporations do elect to file on a worldwide combined reporting basis when it's in their interest. We are in the process of trying to gather that data for the elective states, but we've already gathered information from Massachusetts telling us that in an average year in recent years, somewhere between 90 and 100 corporations are electing to file on a worldwide basis because, as Patrick just explained, sometimes companies pay less US tax or state tax under worldwide combined reporting. So again, the fact that companies are perfectly willing some companies are perfectly willing to file on a worldwide basis when they pay less, again, is an indication that this is that they are capable of doing it. And presumably the states are capable, those states that are allowing the election, and certainly Alaska that's been enforcing worldwide combined reporting for decades is capable of enforcing it vis-a-vis multinational corporations. So thank you for the opportunity to present this morning.
Thank you. That was incredibly helpful. Really appreciate it. And we'll look at your written testimony as well, and appreciate all your help as we work through this. As soon as, the more information you get from those other states, I think that's incredibly helpful to us. So appreciate you staying in touch. Thank you.
Thank you.
Committee, we are done for the day. I do want to offer that I am aware that the House Human Services Committee is going to or has recently voted out S18, which is a bill related to flavored tobacco. We are not picking that up next week. Our schedule is already fairly full. And so it will likely be the week after that.